The power of compound interest in investing. Today, we're diving into one of the most powerful concepts in personal finance, compound interest. If you're new to investing or already in the game, understanding compound interest will change how you think about your money. It's often referred to as the magic of investing because of its ability to turn small, consistent investments into large sums over time. But before we get into how compound interest works, let's break it down in simple terms. At its core, compound interest is interest earned on both the initial principal and any interest that's already been added to the account. So, let's say you put $100 into an account that earns 10% interest. After 1 year, you'd have $110. But in year 2, you don't just earn interest on the $100. You earn interest on the $110, meaning your money is growing faster. Now, let's think about why compound interest is so powerful. The most important factor is time. The longer you let your money compound, the more it grows. This is why compound interest is often called the eighth wonder of the world. It's because over time, the growth accelerates. For example, if you invested $5,000 into an account with 7% interest annually, in 1 year you would have earned $350. But in the second year, you earn 7% on the new balance of $5,350, not just your original $5,000. This snowball effect continues year after year, and over time, your returns compound. The power of compound interest is most noticeable over long periods of time. So, even if you start with small amounts, don't get discouraged. Consistency is key. Even if you can only invest a small amount each month, that money will continue to grow at an accelerating rate. For example, if you invest $100 every month into an account that earns 7% per year, in 30 years, you could have over $100,000. The vast majority of that would come from the interest, not the money you initially invested. Now, let's talk about the importance of starting early. The earlier you begin investing, the more time your money has to compound. This is why time is your biggest ally in investing. The more time you give your investments to grow, the larger the potential returns. That's why even if you don't have a lot of money to start with, it's better to start small than to wait until you have more funds available. Whether you're in your 20s, 30s, or even 40s, starting as early as possible can have a significant impact on your future wealth. A great way to visualize the power of compound interest is by using a compound interest calculator. These online tools allow you to input variables like your initial investment, contribution amounts, interest rates, and time horizon to see how your money will grow over time. A simple Google search for compound interest calculator will lead you to many free resources that can show you how much your investment could potentially grow. Websites like Investopedia, Bankrate, or Smart Asset have great, easy-to-use calculators that can help you forecast your financial growth. When using a compound interest calculator, here's what you need to consider. Principal. This is the initial amount you invest. It's the starting point for your investment. Interest rate. This is the annual percentage rate, APR, you expect to earn from your investment. Compounding frequency. How often interest is calculated, for example, annually, quarterly, monthly. The more frequent the compounding, the faster your investment will grow. Time horizon. This refers to the length of time you plan to keep your money invested. The longer your investment grows, the greater the compounding effect. Additional contributions. If you plan to invest regularly, such as monthly, you can add this to the calculator to see how it impacts your total return. For example, let's say you start with an initial investment of $5,000 and contribute $200 every month. If you earn an average annual return of 7% and keep the money invested for 20 years, you could end up with over $140,000. Of that amount, about $40,000 would be your initial investment, and the rest would come from the compounded growth of your contributions. This demonstrates how compound interest can transform even small, consistent investments into substantial wealth over time. Now, how can you get started with compound interest and make sure your money is working for you? The first step is to invest in an account that offers compound interest, such as a high-yield savings account, a retirement account like a 401k or IRA, or other investment vehicles like stocks or mutual funds. Most people opt for retirement accounts to take advantage of tax benefits while their investments grow, but there are many other options available depending on your goals. For instance, if you're saving for retirement, consider opening a tax-advantaged account like an IRA, individual retirement account, or a Roth IRA. With a traditional IRA, you can deduct your contributions from your taxes, while a Roth IRA allows your earnings to grow tax-free. If you're saving for short-term goals, you might want to look into a high-yield savings account or a certificate of deposit, CD, which also offers compounded interest. Another option for compound growth is investing in stocks or index funds, which have the potential for higher returns but also come with higher risk. These types of investments are generally better for long-term goals, like retirement, because they allow your money to compound over many years. If you're unsure where to start, consider setting up an account with a low-cost, diversified index fund that tracks the market. These funds automatically invest in a wide range of stocks, reducing the risk of individual stock picking while allowing you to benefit from the overall growth of the market. While compound interest is a powerful tool for growing your wealth, it's important to keep in mind that there is no one-size-fits-all approach. It's essential to find the right investment strategy for your financial goals and risk tolerance. This means balancing conservative investments, such as bonds or high-yield savings accounts, with more aggressive investments like stocks or mutual funds that have the potential for higher returns but come with more volatility. Finally, don't forget that consistency is key. The more you contribute to your investments, the greater your returns will be. Even small, regular contributions can make a big difference when you let compound interest work over time. So, whether it's $50 or $500 a month, aim to invest consistently and stick with it. The magic of compound interest doesn't work overnight, but over time, your wealth can grow in ways you might not have imagined. In summary, the power of compound interest is one of the most effective tools available to investors who want to build long-term wealth. By starting early, making consistent contributions, and using a compound interest calculator to track your progress, you can set yourself up for financial success. The key is to take action today, no matter how small the steps might seem, and let time and compounding do the heavy lifting for you.